Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how are you going? Thanks for joining us on the Smart Property Investment Show as we get stuck into property investing in this, what some people would say is the best time to ever be a property investor, what some people would say is the worst time ever to be a property investor. My job is to sort of give you the facts and the information to work out what you reckon and therefore help inform your decision making. And we're fortunate that we've been at this for a few years now, and it's a pretty popular podcast, and people are making or shaping their investment decisions based on what other people are happy to share with their portfolio. That includes us, Smart Property Investment. We've shared our property journey for many years and our portfolio. And I was only just working on it before I come on air, just doing a bit of an update for the website, smartpropertyinvestment.com.au, to give you a bit of an inside view on how it is tracking. Interestingly, I was quite shocked when I was speaking to one of our property managers up on the Central Coast in New South Wales. And I thought the valuation of this property was somewhere around sort of 550 grand, maybe a little bit less. And I was informed by then that they thought it would sit somewhere between 600 and 660. So I haven't really looked at this property for a couple of years, but it gave me some indication of what's going on in the market up on the Central Coast. And, you know, they were telling me, because I was asking the question, should I be reviewing my rents considering supply and demand up there? And they said they have nothing, and I repeat, nothing available on their books for rent right now in houses in their particular area, the Central Coast. So they're thinking lift prices when the lease does become renewed. So I'll be having consideration about that. But if you're a property investor and you have a portfolio, you've got to be asking these questions right now, because if you listen to some elements or read some elements of the news, you'll think it's absolute blood on the streets and price reductions all over the place and vacancy rates going through the roof. That may not be the case. It might actually be the opposite where you have investment properties. So do the ground truth, the ground research, understand what's happening and make those decisions. And this comes down to sharing information with other property investors and those which range on the Smart Property Investment Show from one property to 50 properties. And I've asked someone to come to the studio today who sits towards the top end of that, from what I understand, circa 40 properties, George Markoski. Did I get that right, George?
George Markoski, yes, that's correct.
George Markoski. How's it going, George? What's going on?
Really good. Yeah, look, I'm in Adelaide. It's a sunny day today, pretty relaxed, so it's pretty awesome.
You guys have done better than most. I saw they're already sort of dissecting why places like Adelaide has done so well with COVID. And I think it was on the Gruen transfer, the adverts that you guys were seeing down there pretty early on around COVID, around sort of, I don't know if you ever saw it. It's like a green booger that gets coughed around and then it goes on to everything else. It pretty much, they reckon, changed the way people thought about COVID, hence the reason why you got pretty low rates down there. What do you think of it all?
Look, I don't watch TV, so I didn't see the ad, but I guess not a lot of people come to Adelaide. Maybe that's why we're safe. Bit of a joke.
I thought it's the place to be. They reckon it's all happening down in Adelaide.
It is at the moment, actually. It's really the place to be. It's pretty exciting. Pretty exciting from a point of view where we've got no lockdown, obviously, which is great, and we're COVID-free. But also, in property-wise, it's pretty exciting as well.
Mm. So are you Adelaide born and bred? Is that where you're from?
Yes. Yep. Adelaide born and bred. And when I was younger, I moved to Sydney, the big city of Sydney, which is pretty exciting and scary at the same time, but learned a lot and then finally moved back to Adelaide.
Well, what sort of, I guess everyone leaves Adelaide at some point to go and try and make a name for themselves in the big smoke, whether it's over in London or elsewhere or into the other capitals. What sort of dragged you back?
What dragged me back? Well, funny enough, I was working for a marketing company in Melbourne and I started getting a lot of clients in Adelaide because of the word of mouth. And before you knew it, I had so many clients in Adelaide, it was just easier just living back to Adelaide where I came from. So that's what happened. Fair enough. It's a natural progression. I wasn't planning on coming back.
So you're a property investor. That's your job now? Is that what you do?
Well, look, basically, I retired on property when I was 37. So that's, what I've been doing, property investing. But now I'm getting into the property education and coaching. That's what I'm doing at the moment as well.
Okay. So to help shape my way in which I approach this discussion, George, how big is your portfolio?
Okay, so my portfolio, I've got 39 properties.
All right, and what sort of valuation of those 39 properties do you think it would be?
Good question. I haven't looked recently. What I know is recently I just probably gained over $1 million in equity in my properties.
Okay.
So I've got them sprinkled around between Brisbane, Adelaide and Perth.
Adelaide and Perth. Tell me about your strategy. So what would the sort of makeup be of that particular portfolio? What sort of properties?
Yes. Okay. When I first started, I guess that was quite a while ago, back in the 90s. That was when negative gearing was big and I started doing negative gearing and things like that. It was quite challenging. But I was buying older properties. Then I started getting into new properties so I could get the tax deductions and getting the money back. And I was using the interest only. And now what I do is I do a bit of a mixture of sometimes what I do is I buy an old property, knock it down, do a development, then keep one, sell two, that sort of stuff.
Okay.
You know what I mean?
So 39 properties, and you started investing, late 90s, is that correct?
Yes, that's right. I started investing in the 90s.
And is that why you're living in Sydney?
No, I was living in Adelaide at the time.
Okay, cool.
Yep.
So why'd you start investing in property? What was the game plan?
Look, funny enough, property for me has been very exciting. I remember when I first saw Monopoly and played Monopoly at a friend's house, and I just loved it. And people were saying, you could do this in real life, playing Monopoly, and I thought that was pretty exciting. So always from a young age, I always was interested in property. And I don't know what it was, maybe, having the ethnic parents or the people around me. I don't know what sort of made me think that way, but I remember I got a lottery to win a car when I was 16, and it was a $60,000 holding or something. And my first thought was, if I win that, I sell it and buy property, So I've always been interested in property and just knew that was the way to go. Also, I suppose I came from a family that struggled to make ends meet. And I knew that I could do something. I didn't know any other way of doing it, because you got the stock market, but I don't know anything about the stock market. It sounds complicated. Property is a pretty simple thing, and you can see it, you can feel it, you can own it. You know what I mean?
And what sort of work were you doing when you bought your first property?
Okay, yes. So I was running a marketing company when I bought my first property. And basically, I bought a property in Forestville. That was my first property I bought. And I remember when I bought this property, I was actually running an event in Shepparton. And I had all these people, because I had to go on the microphone, and I had all these people knocking on the door, and I've got the door closed, and I'm actually bidding at auction over the phone. And because you can't see anyone else bidding, so you don't know what you're doing. You're sort of bidding against yourself almost, and it was pretty scary. And then suddenly they say, yep, you got the property. Now, I wasn't sure if I was happy or sad, because I was like, did I pay the right price? What was happening? I just bought a property. I can't believe it. But, I thought, what the hell, I did. And look, that property now, funny enough, I paid $179,000, which I thought was a lot of money at the time. And now it's probably worth about $820,000.
It's not bad. Can't complain.
Yeah. So look, pretty happy with that. Like it really, and I didn't know what I was doing, but all I knew was if I buy a property close to the city, it's going to work. So slowly I've tried a lot of different things. So I tried, buying and doing renos and things like that. And that didn't work for me. That wasn't really a good plan for me. So I remember I bought a property in the northern suburbs in Adelaide, and I needed to rent it out. And what happened was, it was around Christmas when settlement was happening, so I couldn't find any tradies at all. So I had to do it myself, get a few friends to help me and my dad to help me. And I'm sitting there trying to renovate this house on my own, hitting my finger and getting hurt and not knowing what I'm doing and working long hours trying to get this reno done so I can rent it out quickly. And, it was an interesting journey. When you look back, you look at it with fondness, but at the time, 43-degree heat while everyone else was having fun, and I was sitting there working hard. It's one of those things. But, I did a lot of hustling and tried a lot of different things to try to get my property portfolio moving. And some things worked, some things didn't work.
So when is enough for you? Are you still at it, or are you sort of going to stop at some point?
Look, what I do is I slow down a little bit, but at the moment I'm going back in because, what's happening now with COVID, I think it's the perfect storm for a massive jump in property. Because if you look back, back in 87 when we had the stock market crash, everyone's like, that's it, property screwed. But what happened? Property bounced back and doubled. And then we've got the GFC. And after GFC, look what happened to Melbourne and Sydney. So I really, I know history doesn't repeat, but Mark Twain says it certainly rhymes. So I really think, as always, properties are going to rebound quite a bit. And it's an interesting market at the moment, but I really feel it's a great opportunity at the moment to buy property.
What sort of equity position are you in on your portfolio now with 39 properties? Like, what would your LVR be?
Yeah, my LVR is actually pretty good at the moment, and that's what I want to do is try to spread that out a bit more. Because I really think having 20% equity is a really good place to be, because then you're getting 5 times the return. And at the moment, I've probably got about 60% equity in my properties. Because
So-
I haven't really done a lot recently, and they've been growing, especially some areas have just gone up so much, which is pretty cool.
Yeah,
So
and you
I'm-
mentioned that you probably had $1 million increase in equity just over, what period would have that been?
that was in the last 12 months,
Okay.
which I was pretty surprised about. And that was just a couple of star properties that just did much better than I expected. I didn't expect it either. Because I normally expect, if you're going to average, 5 to 7% per year long term. And the thing is, when you get that massive jump, it's really good. But if you plan for it and hope for it and, think you need it, then I think you can get yourself in trouble. You really need to look at the long term and the averages, because that's what works. Because I remember one property I bought in Perth, I paid around $220 for it just before the mining boom. And then it went up to nearly 500 within 2 years. But then it slowed right down. So if you look at over a 10-year period, it still did the average anyway.
Yeah.
But obviously, if you can get your timing right, sometimes it's great. And I think the more properties you have, the more chance you've got to get your timing right.
Yeah, it's all about diversifying, ensuring that hopefully you've got a star performer operating in every market. And if you've got plenty of properties, that means you should have a star performer in some market. We're going to go to a quick break. When we come back, we'll chat about some financing. Back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with George Markoski. George Markoski. I'm struggling with that. What background is Markoski?
Markoski is actually Macedonian.
It's Macedonian, is it? Okay.
Yep.
And for those of our listeners whose Balkan geography is not great, where is Macedonia?
Macedonia is near Serbia, Greece, Albania, Bulgaria, that little corner across from Italy.
There you go. Great place. Really beautiful country, by the way. So what's sort of culturally Macedonian? Is property investment a thing? Like, how does it sort of work?
Well, you look at Europe. What happens in Europe is most people live with their parents, right? So what the culture there is, and it's changing now because people are starting to get their own apartments. But traditionally what happens is you build a really big house and have as many of your kids and families living there, and just generation after generation. But what's happening now is people are moving out to apartments and trying to live their own life, and it's becoming more westernized and different. But it's interesting what's happening in Europe at the moment. If you look at the world stage, property prices in Europe, because the population is going down, they're very different to what's happening here in Australia with our population going up. Huge difference. And you've got places like Italy, as you probably know, and Spain, where they've got whole villages that are empty. No one's there.
Yeah, it's crazy. And this is where a lot of people fall into the trap. And globally, George, where they try and benchmark Australian property against global indexes. And one of them is like, debt to income ratio. And they say Australia's completely off the charts. It's like 10 times the global norm is, I'm just throwing these numbers out there, like 3 or 4 times. Therefore, Australian property is so overpriced, and therefore it's a huge bubble in Australia, and the bubble will burst because it's not sustainable, because it needs to be just like it is in Europe or America. Very different market. So how have you sort of shaped your decision-making when it comes to property, sort of cutting out the noise and just doing things your way?
Look, I'm a bit of a nerd and I'm really into data. So what I do is every quarter I get all the suburb statistics, and put them into a spreadsheet. And then I try to get the supply and demand ratio right and find out, what's going to go up. Because what happens is a lot of experts out there, which amazingly they do this. They go, look, Toowoomba's gone up 5 years in a row. It's done amazing growth. That's where you should buy. And I'm sort of the opposite. I look at a long-term growth and market cycle timing where there hasn't been a lot of growth, but there's potential for it. Because you've got 2 types of suburbs. Ones that haven't had growth because they're just not good suburbs. And you've got the other ones that it just hasn't had their time at the moment. And I find that's what I do. And I rate all the suburbs in Australia like that and go there. But really, it's all a matter of issue of supply and demand. I really think at the end of it, that's what happens. And, you've got 2 types of ways to find out properties. You've got the fundamentals when you're looking at, have they built a bridge here or a new school, or you've got the statistics. And I find I'm more comfortable with statistics because that way you can compare more suburbs. Yeah,
it's a real blend between understanding the data and looking to history to see what happens better, what's happening on the ground. Can you give us some sense, because 40 properties is a lot and there's a lot to go through. Even though no doubt a lot of our listeners would like to go through it. Jenny, can you tell us about the last 5 properties you've acquired, George, sort of starting backwards from the most recent one?
Okay. So the last property I bought was in Brisbane, right? And that was a townhouse, brand new townhouse.
Whereabouts in Brizzy?
That was in Capalaba.
Okay.
I'm glad I got the name right.
Never heard of it.
Yeah, okay. So Capalaba, it's probably about 15, 20 Ks out of the city. Really, I rated that one as number 9 in Australia. So, you got about 16,000 suburbs. Capalabol was number 9 last year, rating-wise. So that's talking about amazing. So what I do is I normally rate suburbs and look at the top 100 or top 200 where I'm looking at buying in. Because obviously out of those 200, a lot of them are unaffordable anyway. That's the thing.
And prior to that, which suburb were you in?
Okay, prior to that, trying to think back, because I haven't bought anything for a couple of years. So Parkholme in Adelaide.
Okay.
Yep. So that was about 2 years ago, Parkholme.
So you haven't bought anything for quite some time?
No, I'm just getting back into the market
Just getting back in the market now.
Basically, to be honest with you, what happened was you've got to do so much paperwork to get finance. I've just hired a new EA. Now I can get back into it because me doing the paperwork, I just can't be stopped.
Yeah. Well, let's have a chat about that because I want to discuss financing because
finance is one of the hardest things. Yeah.
Oh, it's a nightmare. And finance, to be fair, is the thing that stops me from buying more property. It's not because I can't get the finance. It's because I can't be bothered to do it.
Yes.
Because it's an absolute nightmare. So when you go for financing, do you have to provide information about every single property you have in terms of rental statements and debt?
When I go for finance, I really need to get my EA spending a week or two doing the paperwork for me. And it really, the more properties you have, the harder it is. And that's the one thing, because one thing banks don't like you if you've got too many properties, because then they think you're a professional investor. So what happened was, while I was retired, it was very hard to get properties. And now I've started a business and now I've got the business and that helps me get properties because I'm showing income. Because they don't like rental income. And normally they discount the rental income by 50%. Which really makes it difficult. And I really think that's ridiculous because at the end of the day, the one thing you can guarantee is getting your rent. More than getting your paycheck and more than getting profit in the business. I think, properties and houses are safer than a job or anything like that.
Well, the challenge is with banks and lenders, and this is when you start getting a large portfolio. And a large portfolio is pretty much anything over 6. There's only 20,000 Australians that have more than 6 properties, right, as investments. So It's a large portfolio once you get over 6. So you're 39, right? You're quite unique. But lenders often don't delineate between what would be good investment stock and not so good investment stock. So they get nervous about rental income because they just frame it sometimes as an apartment in a high-rise area where there's heaps of other apartments that stay vacant for ages and vacancy rates, so I mentioned, sort of going through the roof, which isn't the case. No doubt where you're investing, there's probably good demand, and probably one of your points for around investability is vacancy rates and ability or certainty of receiving rent. So what's your lender makeup like? Are they all the big banks and second-tier banks and that sort of stuff?
Look, I've got a chunk with the four banks, but now what I'm doing is, what I do is I use a mortgage broker, a mortgage manager, and basically whenever I'm looking at a loan, I'm looking at what bank's going to give me the right valuation for that area. And so it's a bit of an art and a science. People that go straight to a bank for finance are crazy. You really need to use an expert that knows what they're doing to help you through that. But the challenge is, when you're buying a property, you've got to get the valuation right, for one, unless you've got a lot of equity. And two, you want to try to get the interest rate second. But really at the end of the day, what I do is I look at the cash flow and can you afford it? And is the property going to go up? But as you said, Bill, which is really an important thing, is the actual vacancy rate is so important. And banks don't look at that. You know what I mean? But you want to go for somewhere with a low vacancy rate. Anything with a high vacancy rate is going to be very challenging for you, especially as an investor.
So you've essentially changed your position. So you're back, you've got a job now, so you can show, inverted commas, pay slips.
I've got a business now.
You've got a business. So with financials, which means you have cash flow, which banks quite like to see that sort of stuff, even though, and it's an important point you say that they discount rental income by 50%. And depending how you got your things structured, they might even discount that further. And a lot of people who are SMEs or small business people use property as a wealth creation vehicle. And a lot of smart SMEs I know, they use the cash flow they generate in their jobs or their business to create wealth through property. How have you gone sort of on the financing front? Because a lot of SMEs try and I'll inverted commas again, minimize their tax so they don't have to pay too much, but that therefore compromises their ability to borrow money because they're not showing profit and income. How do you sort of balance those things?
That's a great question because that happens for a lot of people. And I know a lot of other small business owners, and I get that because one thing, you want to keep your tax as low as you can as a business. But the thing is, but when you show that to the banks don't like it. And how do you do that? So what happens is certain banks are happy to take different things. And obviously you can go full doc or low doc, all right? And as you probably know, with low doc, you're paying high interest. So what you've got to do is you've got to balance out. You've got to go, okay, so if I pay more tax and show more income, how much tax do I have to pay? How much is that going to reduce my interest? And is that going to balance out? Because sometimes it's worthwhile going in, paying extra tax, showing a lot more profit, even more than what you earn, just so then you can get your whole portfolio on a full doc loan and just do it all in one hit. But as you're accumulating properties bit by bit, it's easier just going low doc and paying the extra interest until you're ready to pay that extra tax and do it again. So there's lots of different strategies like that, and that's sometimes what you have to do, because at the end of the day, it's hard to balance out having a business and showing profit and getting a loan from the bank. But some banks, for example, are happy to take a letter or even take just 1 year's financials. Other banks will take 2. So it depends on the bank. That's what you've got to pick carefully, because sometimes if you had 2 really good years, then you can do what you need to do.
Yeah, and it is very strategic, and you need the right people on your side. I echo your sentiments around a mortgage broker. I literally couldn't get finance, and I imagine the same would apply to you if you went directly to a bank, because they just wouldn't understand it.
I totally agree. Totally. And the funny thing is, I remember when I first started investing back in the 90s, I had a bank manager at ANZ. And seriously, I'd look at a house, I'd ring him on the phone and go, hey, I found a house, it's $450,000. He'll go, I'll call you back in 20 minutes. He goes, yep, you can have that. That was it. A phone call. And I had a pre-approval on the phone in 20 minutes. And now the ANZ Bank, they want to come visit me, see what I have for breakfast, measure my shoe size, and
Right. The world has changed quite a lot. But, this whole sort of responsible lending stuff's getting wound back by the bank. So what's going to happen to financing as a result of that? Who knows? But, your mortgage broker, absolutely critical if you want to build a big portfolio, but also accountant. Have you got a good relationship with an accountant? You must do.
Absolutely. Look, your accountant, the circle of safety, the people around you that you've got, the professionals, your accountant, your mortgage broker, and all those other people around you, your lawyer, your conveyancer, very, very important. And I really think if you're building a portfolio, they need to know your long-term strategy, what you're doing, and they need to be able to communicate with each other so they can work well. So my accountant and my mortgage broker, they communicate, because really at the end of the day, they need to, because we need to say, okay, this is what we're doing. Is that going to affect you? Because what my accountant does can affect my borrowing capacity. So I need to be careful. So he might say, look, we can show you this much profit this year. And I might say, look, I want a bit more profit if we can. Yeah.
And you work it all out, and there's a compromise with that. And also is structure. I want to have a chat about that. Let's go to break before I hand back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with George Markoski. Structure, 39 properties, a bit of a headache. How do you keep them? How do you house them?
Oh, look, when I first started, I was all over the shop. So some of them were quite messy, because what's happened is the land tax rules have changed recently in South Australia, which sort of has affected me, unfortunately, because I've got too many properties here. So what's happened is recently in South Australia, with land tax, if you had a property in a trust, then that was deemed separate to another trust. And then if it was owned by 2 different entities, so what would happen when I buy a property is I'd buy, one in the trust, one in another trust, then one owned by 2 trusts together, and you keep going. But now they've changed the laws, and what they do is if you got it in a trust, they actually pay more land tax. So now I'm in the middle of untangling this whole tangled thing. So I've got some properties in my personal name, but I also use trusts to buy properties as well. Now, generally what you do is use one trust per property. Unfortunately, I didn't do that when I first started. And now, it's become complicated because of that. And the other challenge is obviously every time you get a trust, you've got to pay more when it comes to your accountant as well. For each trust, you've got to do the profit loss and that sort of stuff.
Yeah, it's an absolute headache, and be careful what you wish for sometimes. You want a large portfolio, the administration around it, and trust structuring or tax structuring is an absolute headache. And it's very similar, different rules in different states across Australia. In Queensland, for example, if you're under a particular threshold in value, you don't pay land tax in a trust. In New South Wales, you pay land tax from the very first dollar onwards. So it's very expensive. And look at the biggest cost in my portfolio outside of mortgage repayments is land tax. It's a huge number. It's probably a third plus percent of all the expenses in my portfolio. Would it be the same in yours?
Look, now it is because I bought a lot of properties in Adelaide. Before it wasn't because of the structure, but now it is. So what I'm doing now is I'm trying to spread out more around Australia. And as you said, like in Queensland, you can own up to $700,000 worth of land and that'll be fine. But what's happening at the moment is they're revaluing all the properties in Adelaide, in South Australia, and I think they're going to push the value up, and that's going to hit everyone very hard.
It sounds like a bit of a sneaky play, right? Let's revalue the land, and that's the valuer general or wherever it is. That's who it is in New South Wales, and they change the rules. You think they'd have to grandfather that rather than just applying it just backdated?
I totally agree because, I mean, the old land tax rule was in since early 1900s, right? But they're not grandfathering it. And what they're doing is, well, what they've done recently, I mean, Adelaide is pretty crazy in South Australia. What they've done is if you own a heap property, like I'm talking $100 million worth, you're going to save so much money. But if you own 5, you're going to get hit really hard. So they've hit the middle. As always, the middle people get hit, the middle class get hit the most, don't they?
Yeah, that's crazy. So you're untangling now by selling some properties and reparking that cash in other locations. Is that the sort of media strategy, is it?
A lot of people are already at the moment in Adelaide. So what's happening is a lot of people that have got property, because a lot of my friends are into property as well, and what they're doing is, one, they've stopped buying in Adelaide, which I have as well myself. Because normally I'll drive around and if I see something, I can't help myself. I want to buy it. But now I look at it and think, land tax, I'm not going to touch it. So I'd rather buy it state. So a lot of people are doing that. And so that should be interesting what happens, because what's happened is the land tax rules only came in recently. And now everyone's been hit with these letters because everyone got a letter saying, hey, you're going to save money in land tax. Great news. The government's done you a favour. But now that the actual land tax come out, I think people are going to be surprised that they're not saving money. It's actually going to cost them, except for a few rare cases. The reason they were doing it was to balance the budget. So you can't say we're doing this to balance the budget, but you're going to save money. That doesn't really make sense.
Balancing the budget largely for state governments is trying to generate more revenue rather than find ways to spend less. That's typically how governments go about doing this. But I imagine there's got to be some smart bean counters have gone, that's going to have quite a significant impact on property markets. If investors aren't investing in Adelaide for this particular reason and they're selling their properties to spend their money elsewhere or park the money elsewhere, that's going to have a negative impact on price growth, I would imagine.
Look, it may have a little small impact, but I really think any of these bumps in the road, including, COVID or GFC or even the land tax, long-term doesn't make any much difference because property is such an intrinsic value. And if you look at Australia, everything for us, and that's part of the reason I think property price in Australia is so powerful, is because, one, everything's becoming cheaper. South Australia recently, for twice now, had all its energy met by solar power, complete renewables. So you think about it, electricity is going to get cheaper and cheaper, and everything else is getting cheaper. But there's only one thing that I make more of, which is property, which is land. Yeah,
well, interesting dynamic. So what's the future look like? When do you sell a lot and go and drink pina coladas on a beach somewhere in Macedonia's landlocked, isn't it? Has it got a coast?
Yes,
it's landlocked. Yeah. So on a beach somewhere near there.
Look, I love going to lots of different countries, and I was born in Australia, so I'm Australian anyway, just Macedonian background. But look, when I retired, what happened was I ended up putting some money in an offset account, about 380 grand, got a house on the beach in Adelaide, right beachfront, got a convertible Porsche, and just had a really good time. I got bored. It got boring. So retiring's great because I was doing 80 hours a week with 3 different businesses. So when I retired, it was like, wow, I'm so pleased to retire. But then I got bored. So I'm not really into retiring. I enjoy working now in my own hours, and I find it very satisfying. So I think I just need to get that balance. At the moment, I'm probably working a lot more hours than I want to, but I can't help myself sometimes.
How long did it take you to get bored?
With being retired?
Yeah.
Probably about 2 years.
Okay. Well, that's not too bad.
Yeah. So after 2 years, when I go on holiday now, because I normally go, twice a year, except recently, when I go on holiday, and we go on holiday, and after about 4 weeks, I can't wait to get back to Adelaide and start working and doing stuff. That's it,
So will there be a point where you cash out and that's it, or is this a generational play?
Well, look, the thing is, I can't see the point in cashing out because, I've done the numbers, and you look at a property. If you got a property and you sell a property and you pay capital gains, well, then you're losing a percentage of the property. But if you keep it and pull the money out, equity from the bank, and have the cash, you almost got the same money. without selling the property, but you still got the asset. So I don't know if cashing out is the right way to go. Personally, what I want to do is I want to increase my leverage at the moment, the 80-20. But what I'll do is obviously afterwards is allow the equity to grow and just put it in there. But, I don't plan on retiring anyway. And I think property, the people that make money at property, they don't sell it, they buy it. Selling, I've sold a few, but I don't like selling. I just like buying and holding, because when you hold them, that's where they come. Because the first doubling, properties double every 7, 10 or 12 years. And the first time they double, it's pretty exciting. But the second time they do it is more exciting. When that $179,000 property went up to 300, that was exciting. But when it went up to 800, considering the original money, it's just crazy. So I really think most people, they got to understand that property takes time. And you can't make money super quick in property. And, there's people that buy and sell property and make, quick amounts of equity here and there. But I really think that if you hold it for a really long time, that's where you make your massive money in your return.
Yeah, there is, opportunity costs sort of trading in property, and you got to get hit somewhere, and you only get taxed typically when you realise the value creation. So hence the reason why you've got families, third and fourth generations with these huge property portfolios that have seen, 8 or 9 market cycles of doubling, and that's where the rubber really hits the road. So it's always tough with a large portfolio how you strategize growing it. But so you obviously still enjoy investing in property?
Love it. It's a lot of fun. It's really exciting. I mean, property shouldn't be exciting because it takes a long time, but it's I still enjoy buying properties and enjoy doing it. It's great fun.
Cool. All right, I've enjoyed the chat, George. Mate, thanks for joining us today.
Thank you. Really enjoyed it. It was fantastic.
Nice one. Now remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily morning newsletter, so the first to know what's going on in property right across the nation, smartpropertyinvestment.com.au. If you'd like to follow us on social media, that's how a lot of people like to get their info. Just search Smart Property. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you ready for a career change? Have you ever considered mortgage broking? The New Broker Academy is the must-attend virtual conference that delivers the blueprint for building a successful business for every new broker. Discover why the demand for mortgage brokers continues to soar and how you can become a part of this lucrative and booming financial services sector. Register for free today at newbrokeracademy.com.au.